Hey, welcome to the podcast, everybody. Thanks for joining me. Well, another day, another 500 points. All right, up, down, down. It's almost comical, except the fact that it's your retirement money going up and down potentially, depending on how you're positioned. So it can be frustrating, but another day, and it's a day of opposites. So it seems to me, perhaps one would bet on the fact that we may be down 400 or 500 points tomorrow. Seriously, let's look into this a little further, and I've got some opinions on not only why I think this is happening and how it's developing, but also there's another time in history that's looking very, very similar to what we're seeing right now. But first, let's go through this. We had the Dow Jones up 423 points to 11,143. The S&P 500 was up 51 after being down 51 yesterday. It finished at 1172. The NASDAQ up over 100 points once again. Big, huge move in the NASDAQ, up 4.69%, 2492. And some of this, of course, the media is saying, well, this is because Cisco came out with good earnings last night. That wasn't it, because the futures were down this morning. That had nothing to do with it. Well, the initial jobless claims were only 395,000 when the estimate was for 405,000. Don't think that's good enough either. It went up because that's what the market's doing right now. The sellers got exhausted temporarily. Even the bears this morning were suggesting, hey guys, don't put on any more short positions just yet. Let it rise a little further and then put them on. So even the shorts were getting bullish. Even the bears were getting bullish. So it did rise, but let's go ahead and take a look at what actually happened today. So you can see the stock market obviously sold off into the close. We gapped up into the this morning. Futures were all over the place, right? All over the place. And then we opened up. Little selling came in, and then it was kind of off to the races. But we kind of paused at this 1150, 1155 area, and I'll get to that in a minute why I think that happened. I tweeted that between 1120 and 1160 was kind of this range. If we could break out above that, we'd be off to the races, and you can see it did. It broke out, and there was persistent buying throughout. That's very important because the bulls need that persistent buying. They don't just need an up 100 day. The bulls need to show that they're in charge. So you have this battle back and forth, right, between the bulls and bears right now. In fact, in the last 4 days, you've had 90% down days in a row, 4 of them, up, down, up, down. And so you really see this battle brewing right now, and it's quite amazing to see the moves that we're getting. But in order for me to become really bullish, I would like to see the bulls take control for 2 days. We haven't seen 2 days back-to-back yet. But you can see we had a very persistent up day all day today. Now, I've changed the picture to a 5-minute picture of the S&P going back a few days, and you can see that that's why I really wanted this 1155, 1160 area to break out, because we were kind of stuck in there. And once we broke out of that area, then it was kind of off to the races. So you can see that's the area that was kind of forming this sideways. Even though we were moving 500 points a time, it was basically sideways. Now, there were a few tells yesterday that I think were telling us that the stock market could rally and rally big. When it was down about 400 yesterday, there was not near as many stocks down that had been down the few days before. The last Thursday when it was down 500 points, indiscriminate selling, right? Selling across the board, closed-end funds, REITs, you name it was going down, getting just pummeled. I mean, talking 7, 8, 9, 10% stocks that were down 15, 20%. The only thing that was working were Swiss francs, gold, and treasury bonds. So the tell was yesterday when it was down 400, I saw some green on my screen. I saw some stocks that were up. I saw things that normally on a down day maybe they'd be down a little bit. They were down just a little bit. Some of these closed-end funds were down 1 or 2%, not 8 or 9%. So I started to get the feeling, okay, there are some people nibbling on some things. And that wasn't the case a few days ago or even last week. It was just indiscriminate, forced selling, mutual fund managers having to sell, hedge fund managers having to sell because they buy things on margin. These things were causing a real force down, indiscriminate selling. Yesterday, I did not see that. So when it was down about 400, I went in there and bought some energy stocks. I bought some agricultural stocks. And, those were things that were, I thought, holding up very well. The agricultural stocks were actually up yesterday most of the day. So that told me that we were getting possibly a pretty good setup. The other thing was, you notice this inverted head and shoulders here. We saw this, a big drop on the 9th a couple of days ago. And then, of course, that was the day that the Fed came out. We took that initial drop down to close to 1,100. The market bounced all the way up and then, of course, gave it all back yesterday. But we didn't go down to the low. That was the key. We went down to what would be the right shoulder, last night would be the right shoulder of this. So that we were setting up for something good, but who knew? European banks, all these problems. We didn't know how it was going to open up. But once we started to rally, it had that feeling that it was going to persist all day long, and that's exactly what it did. Little profit taking towards the end of the day, but that's to be expected on it. When we were up 500 and something points today. Now, what's interesting about this, I told you guys the other day, you start looking at the stock market on an hourly basis, and it starts to become a little clear what's going on right now. Starting at the 25th, 26th of July, right in this time frame, we started to get this downdraft, and it was just persistent. I mean, hardly any up days at all, and it didn't really stop until the last few days. And what you're seeing now, and I just put a 10-hour moving average on there, that you can see at least this moving average is moving sideways now and actually turned up. That had not been the case at all, going all the way back to late July. So you are seeing some positives here that we haven't seen in quite some time. Now, does this mean that the worst is over? That very well could have been the bottom. But again, what we need to see is a strong commitment on the part of buyers tomorrow. Futures are down a little bit this evening. Let's see if the buyers come back in tomorrow and push it up even further. Once they do, then you start to see the bears say, okay, that's it. And then you also see people that said, boy, I should have bought that stock last week when I had the chance. It's the train leaving the station mentality. Once you see that, then I think we've formed a bottom. But when you get these types of events, often bottoms aren't that easy. They don't just come and that was it. You'll notice that we were going sideways for a little while here, and we've actually broken out. And we've broken out of this box. If we can come back down and get into the 1155, 1150 area and then turn around and head back up again, that would be extremely bullish. And then you could say, okay, we've got something here that could last a while and have a nice, big, profitable trade other than something that's going to last 3 hours, which is what we're getting right now. So I do look for further strength. But let's watch this because it's still anything can change minute by minute. So again, gradually scale in and use some stops. Now, I want to point something out. And this is really interesting and something to take into consideration when you think, are we in a bull market? Are we in a bear market? One thing to consider is that bear markets often do start with stocks extremely expensive. 2000, obviously, with the tech bubble and so forth. And even 07, stocks weren't terribly cheap. But when you look at a stock now, and let's take Google, for example, which I just recently bought. But if you take Google and we go back to 2007 near its peak, you can see the stock. Now I've got two lines on here. The white's the stock price. So let's go back. It's 562 today. It was 562 back in September. Here's the key, though. Look at the green line. The green line's the PE ratio. Now, as you all know from following me for months or years, you know that I'm not huge on PE ratios. I think it has a part. You have to see it, how fast the company is growing in relation to the PE ratio. You have to see versus its peers, versus its historical. So you can use it, and it's one element of, looking at a stock, but it doesn't often correlate into, okay, low PE ratio equals you're going to make money with stocks. But do want to point something out here. It's very fascinating. If you look at the fact that Google is at the same price it was back in October of 07, look at the green line. Over here is a PE ratio in green, and here's the scale. It was about 45, and it's at the stock's at the same price now, but the difference is the PE ratio is down here at 20. So what you're noticing is that a PE ratio has a numerator and a denominator. Okay, I know you didn't want a math class this evening, but if the denominator is going up faster than the numerator, you're going to have a PE ratio that's going down, and that's what's happening right now. Is these stocks are at the same level they were sometime in 07, and so you'd say, well, look at the stock. It's already doubled. In fact, if we look at this, let's go to October of 2008. It's interesting because you can see the stock market, the stock has run up from 300 to 562. So it's almost doubled. Just a week ago, it was up 600. So the stock price has doubled. Yet, look what you're paying for the stock. You're paying the same price. You're paying 20 times earnings today, and you paid 20 times earnings back in 2008. So when people look at stocks and say, well, boy, it sure is expensive. The stock has already doubled. How much higher could it go? You have to look at how much cash flow they have, how much earnings they have. Really do your homework and tear down what are they doing inside the company with their earnings, their profits, their balance sheet. There's a lot of stocks out there that look like this. I just picked this one out because it's such a high-priced stock, and people would go, well, I'm not paying $562 for that stock. Well, you have to realize that Google has a lot of earnings. 20 times earnings is not that expensive for a fast-growing company. I've been very bullish on this Google Plus that just came out. So that's another stock I picked up in some of the carnage here recently. But anyways, just take some of that kind of stuff into consideration. Again, PE ratio is not the end-all, be-all. But you do see this pattern where stocks have been getting cheaper the last couple of years, and the prices of the stocks are going up, and so you're not paying any more for them. The reason they're falling so fast right now is people are trying to figure out what is the E? How do we come up with a PE ratio or price-to-book ratio when we don't know what those other parts are? We know what the price of the stock is. We don't know what the E is. What if the earnings come in $10 less per share on Google? Maybe now the PE should be 25, not 20. Now it's more expensive. So that's one of the confusing parts when you're going through this economy shrinking or contracting potentially, is that earnings may do the same. And that's what was wrong with this earnings season. The earnings were really good. It was the forecast on some of these companies by them saying, I don't know how it'll look next quarter. And so now you're getting the sell-off because, hey, sell first and then we'll do the homework and figure out. And that's kind of what the mentality is. But take that into consideration when you're looking at some stocks as well. Have a wonderful day, everybody. Thanks for joining me. Appreciate it, and we'll talk to you soon.
This show is for entertainment only, and information provided by the host, guest, and this station should not be deemed as advice. Your investment decisions should be based on your own specific needs. You should do your own research before you make those decisions. As president and CEO of Eggers Capital Management, Carl Eggers may hold securities mentioned in the show for himself and his clients. Just don't buy or sell anything based on what you get from radio or TV. Use your own judgment, or get yourself a trusted advisor.